Good morning, Europe, and welcome to a crucial start to your trading day. Here in the United States, our markets are still closed, but the futures tell a compelling story about how investors are positioning themselves overnight and heading into the new trading week. We're seeing some subtle shifts across the major index futures, a testament to the underlying currents of uncertainty and anticipation. The general sentiment suggests a cautious stance, with market participants digesting a flurry of economic data and, perhaps most importantly, the dawn of a new era at the Federal Reserve. The VIX, our fear gauge, is certainly reflecting this heightened sense of unease, registering a notable uptick in early hours. This isn't just noise. It's a clear signal that the market is bracing for potential volatility, perhaps driven by the dramatic shift in monetary policy leadership and lingering questions about the global economic trajectory. While the broader tech giants are showing some early softness in their overnight movements, hinting at a period of reflection after recent strong runs, there are certainly pockets of strength and significant stories unfolding that demand our attention. Today, we're not just looking at numbers. We're delving deep into the why behind the moves and the profound implications for your portfolios. The financial world is buzzing with commentary from some of its most influential figures, each offering a unique perspective on the shifting landscape. The most significant news, of course, is the confirmation of Kevin Warsh as the new Federal Reserve Chairman. This appointment marks a pivotal moment, shaping expectations for monetary policy for years to come. Investors are already beginning to adjust their outlooks, anticipating a potentially different approach to interest rates and economic stewardship. Adding to the chorus, we heard from JP Morgan's CEO, Jamie Dimon, who recently voiced strong opposition to proposed caps on credit card rates, labeling such measures as an economic disaster. His comments underscore the delicate balance between consumer protection and the operational realities of the financial services industry, and they remind us of the potential ripple effects of legislative interventions on the broader economy. In the realm of digital assets, the debate continues to intensify. Michael Saylor, the visionary behind MicroStrategy, remains undeterred by recent market fluctuations, reportedly using dry powder to significantly increase his company's Bitcoin holdings. This steadfast conviction, however, stands in stark contrast to the skepticism expressed by figures like Jim Cramer, and more pointedly, the ominous warnings from Big Short investor Michael Burry, who has predicted a potential crypto plunge could trigger substantial sell-offs in traditional safe haven assets. Yet, on the other side of the spectrum, Cathie Wood's ARK Invest continues to strategically acquire crypto-related stocks, suggesting a long-term bullish outlook despite the short-term bumps. Even beyond finance, figures like Elon Musk are making headlines, with his company X facing a police raid in France, which he's termed a political attack. These kinds of geopolitical and regulatory events, while seemingly disparate, contribute to a broader environment of uncertainty that can influence market sentiment. Finally, we must heed the stark warning from Ray Dalio, who believes the world is teetering on the brink of a capital war. His perspective paints a sobering picture of global economic and geopolitical tensions, reminding us that financial decisions are rarely made in a vacuum. These voices collectively paint a picture of an economy and a market at a significant crossroads. Turning our attention to the bond market, we see a fascinating interplay of forces at work, particularly in light of the new leadership at the Federal Reserve. The yield on the benchmark 10-year Treasury note has seen some slight shifts overnight, a subtle indicator that investors are recalibrating their expectations. The prevailing sentiment, as highlighted by recent reports, suggests that under Chairman Warsh, investors are increasingly betting on a steeper yield curve. What does a steeper yield curve signify, and why is this expectation taking hold? It typically implies that long-term interest rates are rising faster than short-term rates. This can happen for several reasons. Perhaps the market anticipates stronger economic growth and, consequently, higher inflation down the road, requiring the Fed to eventually tighten policy more aggressively. Or, it could reflect a perception that the new Fed chair might be more inclined towards a less accommodative monetary stance, allowing long-term rates to be driven more by market forces and less by central bank intervention. This expectation is particularly relevant given the fresh macro data points we've seen regarding US inflation and the US unemployment jobs report. If inflation remains persistent or employment shows surprising resilience, Walsh's Fed might be perceived as having less room for dovish maneuvers than some had hoped. The dollar index, a crucial gauge of the greenback's strength against a basket of major currencies, has also registered a minor fluctuation. This reflects the broader global currency market's attempts to price in the implications of evolving monetary policy expectations not just in the US, but also globally, particularly in Europe, as we'll discuss shortly. The bond market, in essence, is acting as a crucial barometer, signaling the deep shifts in confidence and expectations that are permeating through the financial system as we usher in this new chapter of Fed leadership. The central bank landscape is undeniably dominated by the changing of the guard at the Federal Reserve. Kevin Warsh's ascension to chairman marks a significant departure, injecting a new dynamic into global monetary policy. The market is now grappling with the implications of his likely approach. Will he lean more hawkishly, prioritizing inflation control and fiscal discipline, even if it means potentially slower growth? Or will he prove to be more pragmatic, adapting to incoming data? Reuters reports that investors are already anticipating a steeper yield curve, suggesting a belief that Walsh might allow market forces to play a greater role, or that he could be less inclined to suppress long-term rates. This stands in interesting contrast to some recent commentary, such as the call from the Fed's Mirren for aggressive interest rate cuts later this year. The market will be scrutinizing every speech and every data point for clues on how these differing philosophies will converge or diverge under Walsh's leadership. Across the Atlantic, the European Central Bank is also firmly in focus. Christine Lagarde and her team are preparing for their February meeting, and Morningstar Canada has raised the question of whether the ECB will cut interest rates as early as February 5. This highlights a potential divergence in monetary policy trajectories between the US and the Eurozone. While the US Fed under Walsh might signal a more hawkish stance, the ECB could be contemplating further easing, driven by different inflation dynamics and growth prospects within the Eurozone. Such a divergence would have profound implications for currency markets, bond yields, and capital flows. Meanwhile, the Bank of England is also navigating its own set of challenges, with EBC Financial Group analysing the sterling's outlook against the dollar, factoring in UK inflation and the BOE's rate decisions. The collective picture is one of global central banks facing unique economic realities, potentially leading to varied responses that will undoubtedly shape the international financial environment. The Walsh era at the Fed, however, remains the gravitational center, influencing every other monetary policy decision around the world. The commodity markets are painting a vivid picture of global supply dynamics, geopolitical tensions, and the ongoing dance with inflation. Gold, the perennial safe haven, has certainly captured attention, not just with its overnight movement, but by surpassing the significant $5,000 per ounce mark in recent trading. This is more than just a number. It's a psychological milestone that underscores persistent investor anxiety. The rally in gold suggests a confluence of factors: continued geopolitical uncertainties, perhaps a renewed hedging against inflation, and a general flight to safety amidst the backdrop of evolving central bank policies, particularly with the new Fed leadership. However, it's worth remembering Michael Burry's cautionary note, suggesting that a significant crypto downturn could potentially trigger a sell-off in gold and silver, highlighting the interconnectedness and potential vulnerability of different asset classes. Shifting to energy, crude oil prices have been surging, a development that quickly translates into higher costs at the pump for consumers. This surge is likely driven by a combination of factors, including robust global demand as economies continue to recover, potential supply disruptions, and ongoing geopolitical tensions in key oil-producing regions. Higher oil prices inevitably feed into inflationary pressures across the supply chain, impacting everything from manufacturing to transportation costs. Natural gas, on the other hand, has shown signs of stabilization after previously seeing a gain. Natural gas intelligence reports that spot prices are eking out gains as the market finds some equilibrium. This often reflects regional supply and demand dynamics, perhaps a moderation in weather-driven demand, even as the broader energy complex remains under pressure. The overall message from commodities is clear. The cost of raw materials remains a significant factor for businesses and consumers, and these price movements will continue to exert influence over inflation expectations and central bank decision-making, especially under the new Federal Reserve regime. As we dissect the overnight market movements, distinct patterns are emerging across different sectors, offering insights into investor sentiment. The tech titans, which have largely driven market performance over recent years, are showing some collective softness in futures trading. Companies like Nvidia, Microsoft, Amazon, Meta, and Google are all registering slight declines. This could be interpreted as the market taking a breather, some profit-taking after strong runs, or perhaps a cautious response to the new Federal Reserve leadership and the possibility of a less accommodative monetary environment. Nvidia's CEO Jensen Huang's recent remarks about everything being represented in a virtual twin underscore the long-term vision and innovation in the sector, but even the strongest growth stories can face short-term pressures. Interestingly, Apple appears to be bucking this trend, showing a modest uptick in its overnight trading. This resilience suggests either company-specific positive news, strong underlying fundamentals that are differentiating it from its peers, or simply a rotation within the mega-cap space. In stark contrast, MicroStrategy, a company deeply intertwined with the digital asset space, is facing a more significant decline. This directly correlates with the volatility of its primary corporate asset and reflects investor concern ahead of its upcoming earnings report, as noted by TheStreet.com. It's a vivid illustration of the high-risk, high-reward strategy the company has embraced. Beyond these individual movers, headlines also point to industrials leading the Dow Jones through January, suggesting a rotation into more cyclical sectors. This could imply optimism about broader economic growth, even as tech takes a momentary pause. We're also seeing increasing chatter around high-risk, high-reward opportunities in quantum computing stocks, highlighting the market's continuous search for the next big disruptive innovation. The overall picture is nuanced. A general cooling in big tech, some sector rotation, and specific stories driving individual stock performance, all under the watchful eye of a new Fed chair. The crypto markets continue their relentless, often volatile, journey, presenting a fascinating dichotomy of conviction and caution. While we've seen Bitcoin and Ethereum register modest gains overnight, this comes on the heels of significant recent volatility, keeping investors on edge. The spotlight, once again, falls heavily on MicroStrategy. Despite its stock showing a notable decline, reflecting the inherent risk of its strategy, Michael Saylor's commitment to Bitcoin remains unwavering. Reports indicate he is actively using dry powder to add significantly to MicroStrategy's Bitcoin treasury. This aggressive accumulation strategy, particularly amidst market downturns, defines MicroStrategy's corporate identity. It's a high-stakes bet, with the company's fortunes inextricably linked to the performance of this volatile asset. This narrative plays directly into the broader debate surrounding digital assets. On one side, we have staunch advocates like Cathie Wood, whose ARK Invest continues to strategically acquire crypto-related stocks, indicating a strong belief in the long-term transformative potential of this space, regardless of short-term price swings. On the other, we have prominent skeptics and critics, from Michael Burry's warnings of a potential sell-off to Nouriel Roubini's blunt prognoses of a crypto apocalypse. The market is clearly divided, with strong arguments on both sides regarding the asset class's intrinsic value and future viability. Adding to the complexity, we see signs of continued adoption and integration. Opera's recent announcement of expanding Tether token support in its mini-pay wallet is a testament to the ongoing mainstreaming of stable coins and digital payment solutions. This dichotomy, the unwavering conviction of some institutional players versus the dire warnings of others, alongside the steady march of integration, encapsulates the dynamic and often unpredictable nature of the crypto corner. It remains a space where understanding the underlying motivations and long-term vision is paramount, far beyond just glancing at daily price movements. As Europe moves through its trading session and we look towards the eventual opening of the US market, several key factors will demand our vigilance. The immediate focus will naturally remain on any further comments or signals emerging from the new Federal Reserve Chairman, Kevin Warsh. The market will be hypersensitive to any hints regarding his stance on inflation, economic growth, and the future trajectory of interest rates. His initial public appearances or statements will be dissected for clues, potentially setting the tone for weeks to come. Beyond central bank rhetoric, keep a close eye on any fresh macro data that might emerge globally. While we've just absorbed significant US inflation and employment figures, the market's reaction to these, particularly in the context of Warsh's appointment, will be telling. We also have the upcoming ECB meeting and its potential implications for European monetary policy, which could trigger cross-market movements, especially in currency pairs like the euro-dollar. Corporate news will also continue to ripple through the market. MicroStrategy's struggles ahead of earnings are a specific point of interest, as its performance could influence sentiment around the broader crypto space. Furthermore, the geopolitical landscape, as highlighted by figures like Ray Dalio warning of a capital war and events surrounding Elon Musk's X, can swiftly shift market narratives. Any developments on these fronts could introduce unexpected volatility. Finally, pay attention to the sector rotations we've discussed. If tech continues its pause, where will capital flow next? Industrials have shown strength. Will that continue? The trading day ahead promises to be a complex mosaic of monetary policy expectations, corporate fundamentals, and geopolitical undercurrents. As we wrap up our analysis this morning, it's clear we're operating in an environment of significant transition and heightened anticipation. The most profound shift, without a doubt, is the ushering in of the Kevin Warsh era at the Federal Reserve. This single development casts a long shadow over every facet of the market, reshaping expectations for interest rates, inflation, and economic growth. Investors are actively recalibrating their strategies, betting on a potentially steeper yield curve and grappling with what a more hawkish or data-dependent Fed might mean for their portfolios. Beneath this overarching theme, we see a complex web of interconnected narratives. Commodity markets are flashing warning signs of inflationary pressures, with gold rallying as a safe haven and crude oil surging. This pressure on raw materials will be a critical test for economic policymakers. Meanwhile, the crypto corner remains a battlefield of conviction versus caution, epitomized by MicroStrategy's bold strategy against a backdrop of stark warnings from prominent skeptics. The broader equity market is showing signs of sector rotation and nuanced performance, with big tech experiencing some cooling while other areas show resilience. In essence, what we're witnessing is a market in the process of repricing risk and re-evaluating long-held assumptions. The volatility, as indicated by the VIX, is not just a passing blip, it's a reflection of genuine uncertainty. For investors, this demands vigilance, adaptability, and a deep understanding of the underlying forces at play. This isn't a time for complacency, but rather for strategic positioning, informed by a clear-eyed assessment of global monetary policy, geopolitical realities, and evolving corporate strategies. Stay alert, stay informed, and always focus on the why behind the numbers. Good luck with your trading.